All right.
Hello. All right. We were having a little technical difficulty coming to you live, but we're here and we're welcoming you to our BYOB party. It's not bring your own beer today, though. If you want to have your own beer, you can.
It's all vodka in here, folks.
Straight booze. No. BYOB today, we're talking about become your own bank. So before we get started, we want to welcome you and thank you so much for joining us. This is going to be an amazing event. So please share this out. Tag anyone you think would like to learn this information, how to become your own bank. Invite, tag, share. The more the merrier. And if you have any questions along the way, please feel free to put them in the comments. We'll do our best to answer your questions today live, and any questions that we don't get to, we'll get to them. We promise we'll answer them for you, okay? So be sure as you come in, please let us know where you're joining us from. We'd love to know where you're joining us from. Hey, Instagram. And
we're streaming live on Instagram, Facebook, YouTube, on a few different platforms all at the same time.
Yes, so grab a pen, grab some paper. You will definitely want to take some notes because we're going to share with you information that you definitely want to remember and be able to use. So I'm just going to check really quick while you guys are coming in, entering where you're coming from. I'm going to share this out myself if I can find it.
Says, hey, beautiful couple.
Hello. Okay, I'm having oh, there we are.
On Instagram, we're talking about how to build your own bank, how to leverage that to buy real estate, and also I'm going to show you how even regardless of your politics, how even the president of the United States actually uses this strategy. So we'll show you guys there. If you're on Instagram, you might not be able to see our screen share, but if you go to 6buildingblocks.com/register. You can actually join us on our link where we're showing it. You're going to see all the screen shares and different things. Otherwise, you can just listen to it. What's up, Kevin? How you doing?
Yes. And you definitely want to stay till the end of this event because we have a gift for you. And we're going to show you how to get to the next step. Like if you want to learn more about implementing this information that you're going to learn today into your own finances, we'll show you how you can get more. So definitely stay till the end. We have a free gift for you. And we're about to get started.
All right.
Are you ready?
I'm ready.
Are you ready? All right. Welcome to. I'm waiting for the slide.
You don't have to pause.
I know, but I was waiting for
the cliffhanger.
I know.
Just keep talking and it'll come up.
Oh, all right. Well, welcome to how to become your own bank. If you don't already know who we are, we're Martin and Chelsea Matthews. I'll share with you in just a minute why we're qualified to share this information with you. But I want to share with you really quick why we're doing this event. Because we want to make sure we want you to get the right information so that you can strengthen your finances and create the life you truly want to live. Okay, because the information that we're going to share with you today, it's changed our life, it's changed our business, but it took us a long time to learn this information and implement it because it's not widely known, it's not widely shared. And so now that we've been able to implement it and change our lives and our business, we want to share this information with you. And to tell you a little bit more about us, this is our family, Mr. Matthews, Mrs. Matthews, and our son, William. He's a teenager, 16 years old now, and he actually worked in our business over the summer. So we really are a family business, but we didn't always, we weren't always on the same page financially as a business. We did not always have this information. In fact, before I met Martin, I was a single mom for 7 years, and I really struggled to find a balance between financial success and family success. And if you're a parent, especially a single parent out there, you may be dealing with this yourself. I felt like I was either spending time with my son and broke, or I was making money and I wasn't spending any time with my son. And I hated it. I felt guilty all the time. I didn't feel like I was doing either one well. And I knew there had to be a better way. but I didn't know what it was. And so there was some information I was missing, and I wanted to teach my son by example. I wanted to teach him better how to have the tools to success. And I thought if I could figure it out, I could also not just improve our lives, but I could also help other parents and other families to find a better way as well. So I set out on a journey. I read books. I went to seminars. I tried to find the right information to implement into our lives. And finally, I met a group of financial advisors, and they were teaching people how money works, and they were making money doing it. And I thought, oh, this is it. And so I packed up William and I, we moved to San Diego, and I started working with this group of people. And that's actually how I met Martin. He was also working with this group of people, and he had a little bit more experience than me. So he kind of took me under his wing and showed me the ropes. And the more that we got to know each other, the more we realized that how aligned our goals and the impact that we wanted to make were so aligned that we ended up combining our business and our lives. And now we have a family business together. And now we get to work on creating the lives we truly want to live, and we get to help other people to do that as well. So what we've discovered is that, let me just make sure something, are you coming back?
Yeah, I'm coming back.
Okay. All right. And I can't really see if there's any comments or any questions
That's
right
why
now.
I set up there.
Oh, thank you. Okay, perfect. Awesome. Great. Okay, so let me tell you a little bit about us and why we're qualified to share this information with you, because if you don't already know who we are, again, we're Martin and Chelsea Matthews. We're founders of M Wealth Group. We have clients in, isn't it 48 states now? 48 states. And we have a combined, it says 19 years. We need to update this a little bit because now it's a combined 21 years of experience. Our experience can legally enjoy a beverage,
yes,
an alcoholic beverage. We lead an agency of associate advisors. We've held multiple licenses in the fields of investment advisory, securities, insurance. And we're also co-authors of this book, Let's Fight About Money, helping couples communicate about money, handle conflict, and build an unbreakable financial house. And we help individuals and businesses to properly use cash flow to create personal wealth. And our mission is to deliver measurable results to help our clients build an unbreakable financial house and business so they can live life by design, right? Who doesn't want that? I definitely want to be designing my life, not have life be designing me, right? So this is very important right here. This is how we're going to deliver the information to you today, because our goal is we want to increase your knowledge so you can take more responsibility and have more control. We're not going to tell you to listen to us because we're experts and just do what we say. No, we want to empower you by getting you the right information, the right knowledge, so you can take responsibility for making your decisions that you know are right for you and have more control in your money and your life. Okay, and what we've discovered in our business and our experience is everybody's building an unbreakable financial house, right? I mean, everyone wants an unbreakable financial house, and I'll tell you what that means in just a minute. But everyone's building a financial house. We all have a financial house, right? Some people have a financial shack, and some people have a financial mansion, and some people are somewhere in between, right? And there are 6 building blocks that make up your financial house. And when implemented properly and mastered, then you can have what's called an unbreakable financial house. And what that means is you can handle anything that comes your way. Financially, you're unbreakable. Your finances are unshakable no matter what happens. But there's more to it. It's not just about handling things financially. It's about creating the life you truly want to live and make the impact that you truly want to make, reaching your full potential, because we're all designed with gifts and talents to share. And if we have our finances handled, we can focus on sharing our gifts and talents and reaching our potential and not being stressed over finances, right? So I'm going to introduce to you really quickly what these 6 building blocks are I'm going to tell you which ones we're going to focus on today, and then Martin is going to deep dive into those to show you how to become your own bank. All right? So the 6 building blocks are, number 1, cash flow. This is the money coming in and going out of your household and your business. Okay? If you don't have this one, you can't really do much with the other ones. It's very, very important. Okay? Number 2, building block number 2 is debt management. Understanding the difference between good and bad debt and how to use it to build your wealth. Okay, building block number 3 is reserves. This is so key. We just saw with this pandemic worldwide shutdown, there was a lot of people that made a lot of money, but when that money shut off, they were destitute. So it's about having the right reserves. Remember, we're building an unshakable financial house so you can handle anything, right? Building block number 4 is proper protection, having the right kinds and types of insurance, specifically life insurance. Okay, and building block number 5, build wealth. We want to build wealth, right? We want to not just know how to build wealth, but how to avoid the enemies to your wealth that can destroy your wealth. Okay, and then building block number 6 is build legacy. How to put in place the right things so that all the work that you did to enjoy the fruits of your labor generations after, so that it's properly implemented so it actually happens and it can last. What you built could last long after you do. Okay, so these are the 6 building blocks. When you learn how to implement them properly and avoid the risks that could affect your financial house, you can have an unbreakable financial house. Today, we're going to focus on proper protection, building block number 4, and build wealth, and how using these to become your own bank. And when you do that, it affects all your other building blocks as well, strengthening your financial house, getting you closer to that unbreakable financial house. So Mr. Matthews is going to dive deep into these 2 today, and you don't want to miss any of it. So be sure to take notes.
Yeah, so I'm going to check in with I'm going to pause the screen share really quick and check in with you guys here. So yeah, if you have any questions, feel free to drop them in the comments, whether you're watching on YouTube, Instagram, whichever platform you're watching us on, drop them in the comments. And also, if you share this, we'll have a free gift for you. If you share us, so just hit the share button, share those people you know. This is all information we're giving out for free to show people how you can actually build an unbreakable financial house, build your own bank, leverage that to buy real estate and other assets, even whether you like the cryptocurrency market, whichever field you're trying to get into that you think is great. All of this can help you to do that more efficiently. So why don't you put that on a stand? Maybe Rain can grab the box for it. And
oh, I think it's back here.
So let's get started on my piece here, where I'm going to get a little bit, not super technical, but I'll give you some concepts for you to understand how to think with. The most important thing when it comes to your money is how are you thinking? How are you thinking, and what are you executing on? Are you being efficient? Are you doing things in the best way possible, in the fastest and safest way possible? How do you get there with most certainty? Meaning, how do I predict exactly what my outcome is going to be? If I can predict what my outcome is going to be with more certainty, that means I remove the variables. I remove the things that can knock me off track. That way, I'm almost basically guaranteed to reach my goals if the higher certainty I have with my path. So I'm going to go in there and dive deeper into this and talk about some different concepts, so that we show you how to build your own family bank. I'll give you examples of people who use it. And if you stay through to the end, I'll actually show you some numbers behind it. What are the numbers? How do people use it? How does it look like? Who are some of the wealthy people who use it? All that kind of stuff. I'll show that here on this. All right, so let's get rolling. Okay. So when it comes to building wealth, there's a big, huge problem. Number 1 is you're not being educated about the enemies of your wealth. Before you advance, you got to make sure you don't go backwards. That's the number 1 thing you do. Anytime you make progress, you have to make sure you're not going to have a setback. So when you're trying to build wealth, you're advancing, you're moving forward, you're trying to gain more territory, gain more wealth. So the first thing is you need to know, what are these enemies of your wealth? What are the things working against you that you would need to overcome on your journey to building more wealth? So 3 biggest enemies of your wealth. Number 1, your biggest bill by far is your taxes. Your biggest enemy of your wealth is taxes. That's why you have to understand, how do you minimize your taxes? We said this the other day. We said our income went up and our taxes went down. How did that happen? How did your income go up and your taxes go down? Well, because one of the things we did is we reinvested into our business. We hired more staff. We did different things. We did all that, bought equipment, all these different things we reinvested in our business so that we could continue to build wealth. As a result, by following different tools in the tax codes, we could reduce our taxable income even though our income went up. Also, certain income you can get to you without it being taxed. We'll talk about that here before we wrap up. Second enemy of your wealth, inflation. Look, sometimes we would talk about this and it would not be as real to people. Right now, it's super real to people. You go for gas, you go to grocery stores, you go to buy cars, everything. What happened? They inflated the money supply. Government printed more and more money, so your money's worth less and less. So things cost more.
Our teenage son has even felt inflation. He goes to the store and he comes back and he's like, "Are the cost of things going up?"
Yeah.
He noticed. He notices.
So pay attention to this. When you start paying attention to this, you realize how your money has to grow beyond inflation. And the problem is banks aren't paying you enough interest rates that when you keep your money just sitting in the traditional bank, you don't outpace inflation. You lose value of your money every year. You technically lose money by keeping it sitting there. We'll talk about all of that too. Third biggest enemy of your wealth is market losses, right? Stock market's been doing really well. Over the last 2 years, it's been going up. It's not going to go forever. So you need to be prepared that if you have a big position in the market, whether it's in a retirement account, investment account, all of that, how do you hedge those losses? How do you protect if the market goes down so that you don't lose money? How do you even make money when the market goes down? You can actually make money when the stock market goes down. That's not a subject we'll talk about today, but I'm just giving you ideas and things that you can think with to understand how you overcome. There's tools you can use to overcome these three enemies of your wealth. All right. So let me go back to the full screen here.
And if you guys have any questions along the way, feel free to put them in the chat and we'll do our best to answer them today.
So I'm sure your strategy, the wealthy banks, including regardless of your politics, including the current president of the United States, uses this strategy. He's been using it since the 80s. Banks, big companies use to defeat these three enemies of your wealth. So if we look at the problem, right? We talked about one, you're not learning about the enemies. The other problem is that you will earn $1 million in your lifetime. You will earn $1 million. You will collect, your household will be paid $1 million in a lifetime. If you make $50,000 a year and you work for 30 years, you would have collected $1 million. The problem is it took you 20 years to do it. However, let's look at how much you save out of that money and then how does that money grow and compound. So if I make 50 grand a year and I save all of it, I save the entire 50,000. If you're married, listen to this part, especially if you're married, because if you're married and you have two incomes and you have the ability to store one of your spouse's income, you can store one person's income. This is the wealth potential your household has if you're strategic with something like this. So if you save all 50,000, now of course it's not very realistic for a person to save all 50,000, but I want you to see the big picture of this. If you save all 50,000, you make $50,000 a year, you save all 50,000, you're earning 5% on that money. Not even a crazy return, just 5%. You'd have over $6 million by the time you ended your working cycle, right? You're going to work for 40 years at least. If you were saving that $50,000 a year, earning only 5%, which is not a super high return, but is a very, very good return, very good stable return, you would have over $6 million. This is what this looks like on a chart, right? See all that green, that's we call that your wealth curve. Your money's curving upwards. I want to show you how to keep this working for you and do all of the things that you want to do. Buy cars, buy other assets, accelerate the growth of your wealth, all of that. So
I want it all.
Now, first enemy, taxes. If you have to pay 28% income tax and you save what is left over, remember you would have had $6 million, but if you pay taxes and then save every bit of what's left over, you'll end up with $4.3 million. So taxes by itself alone cost you $1.7 million in wealth. This is one of the reasons why you want to look at how to build your own bank, because you can, when we show you the strategy how it works, you can actually access money inside of that vehicle tax free. So 1.7 million in wealth that tax alone costs you, and that's just on one person making $50,000 a year. Multiply that by a household, that goes higher and higher. So this red line on the bottom, that's taxes. You see how that compounds over time? It gets larger and larger and larger the longer you're working and paying taxes. You got to pay attention to taxes because it steals your wealth. So after paying for the lifestyle and for taxes, here's what it looks like for most people. See, the red part represents their taxes and their lifestyle. The green part represents how little wealth they actually have once they get to retirement, whatever age that is. Most people don't end up with a lot of wealth, even though over their lifetime they've collected a decent amount of money. Because it wasn't used efficiently, they end up with very little wealth. That's why there's a retirement crisis. That's why people don't have enough money to retire, because the money was stolen by taxes, lifestyle, inflation, all of these things, and they could not overcome all of that through the growth of their money. So if you look at inflation, there's three ways I want you to look at how to view money, right? There's three different ways to look at how to view money, how to think about money. And most of the times when you're dealing with a subject, if you're not getting the results that you want in that area, it just means there's something that you don't know about it. Doesn't mean you're not smart, doesn't mean you're not capable, doesn't mean you're stupid. It just means there's information that you're missing. The dots are not connected for you. So what we're trying to do is help bridge the gap between where you are and where you want to be, and what knowledge you need to gain and what things you need to do so that you can end up where you want to be.
Increase your knowledge, have more responsibility, and have more control.
Awesome. Yeah, thanks for sharing, guys. Appreciate the shares on there. So I want you to look at whenever you start thinking about money, there's three different ways people view money. They view money, number one, as a spender, which means I get money, I spend it on stuff. View money as a saver. I get money, I don't know if I'm going to get some more money, so I need to save. I need to save and hold on to this money. And the third way people view money is as a banker. A banker. How does a banker view money? They view money very differently than a spender or saver. Money plays a different role in the banker's world. So we'll talk about that and why it's important for you to start looking at money as a banker, how to become your own bank so that you can accelerate the growth of your money and recover some of that lost money that you would have lost to taxes, inflation. How do you have that working for you at all times? So spender views money as a way to buy stuff. Every time you purchase, it costs them interest. Now, it's important to understand that whenever you borrow money, you pay interest. Whenever you pay cash, it still costs you interest. Everybody says, oh, I'm going to pay cash and save interest. I'm going to save the interest I'm going to pay by paying cash. When you pay cash, it costs you interest. Interest it costs you is the interest you would have earned, but you're not earning because it paid cash. How can you do both? How can I have my money working for me at the same time and buy the things I want to buy and still make money, still have my money continue to grow? That's how a banker sees money. We'll get to that in a second here. But once you understand this fact, whenever you borrow money, you pay interest, and when you pay cash, you give up interest. Somebody asked a good question here. Says anniversary follower, Austin. Good job, Justin. I think he's been following us for a bit.
Happy anniversary.
Yeah. Regarding, it says maybe he's been following us for 2 years, I guess, on there. It says, regarding being your own bank, how do you feel about doing that by going decentralized or investing in crypto? I like that idea and that concept. When I get through the piece I've got to show you guys, I want to show you how you can leverage it to buy, how you can build your own bank and leverage it to buy other assets, how you can leverage it to buy real estate, how you can leverage it to create a multiplier if you like crypto, and how you can even do some of it safely, and how it can all be secured. Even if you live a long time, if you pass away prematurely, how do you do all of that? I'm going to talk about that because crypto is becoming more and more adopted by more and more people. Even big institutions are putting some of the assets into cryptocurrencies. And a lot of them don't fully understand it and don't fully understand how to maximize it. We'll talk about that, how you can actually use your banking structure to leverage to buy crypto. And I'm going to talk about how one of our clients actually did that. He did that and then got a 4x return, not 4x, but 400% return on one of his cryptos. Now, I'm not saying that's going to happen for you. I'm just saying this is what one of our clients did. And I want to get to that here before we finish today. So stay tuned through all of that because I want to talk about it. So the spender, how does spender look at money? Spender looks at money. Hey, I'm just going to buy stuff. So I'm going to look at 3 ways to buy a car so they can just understand the concept itself, right? So if I'm going to buy a car, I can borrow the cash. I can borrow money to buy the car. I can pay cash, or I can use something called my private family bank to do that, right? So let's look at purchasing a car for a second. If I go to buy a $30,000 car every 5 years at 0% interest, after 11 purchases, the borrower, if I borrowed money, I would have spent $330,000 because there was no interest. If I paid cash, I also would have spent $330,000, right? No interest on it. Now, what if there was 5.5% interest? The borrower would have spent $378,000. That's what it cost that guy. The cash buyer would have spent $330,000. So a lot of people will look at that just at the face value and say, well, it costs more for the borrower, so I'm going to always pay cash. So it makes people think that it's always best to pay cash. So the saver, he saves up money and he goes to pay cash because in his mind, that's the best thing to do. I'm going to save this money. I'm going to go pay cash for it. So this is what it looks like. Goes into debt. This is the borrower. Goes into debt, try to pays it off after 5 years. He's back at 0. He paid off his debt. He buys another car, goes into debt, goes to pay it off again. Buys another car, goes into debt, pays it off. This is the cycle the person goes through. The next guy is the cash buyer. What's the first thing the cash buyer has to do? He's got to save the cash. He saves the cash, he accumulates and saves the cash. Then he pays cash for his car. He does this again. He saves up the money, saves it up, pays cash for the car. He ends up back at 0. He saves up the money, spends it, ends up back at 0. The guy who goes into debt, pays it off, ends up back at 0. Both people end up back at 0. $0. They got into debt and got back out of debt and they got back at 0. They saved the money, but they used it and they got back at 0. So you understand, both of these people end up in a continual cycle of being back at 0. They cheer themselves on for paying off the debt and they cheer themselves on for paying cash, but they end up back at 0. Their wealth is not growing as fast or as exponentially as it could. So is there a better way to do this? Is there a better way to handle our money? So the banker realizes that earning interest is more important than paying interest. So the banker always keeps his money working. How do I always keep my money working and buy the car at the same time? This is why billionaires who can easily pay cash often get mortgages. So why would a billionaire who can pay cash get a mortgage? Because they understand banking. They understand that it's more important to earn interest. Even if I have to pay interest somewhere else, it's more important for me to earn interest on my money. So I'm willing to borrow money, willing to finance, because I can earn more on my money than it costs for me to borrow. This is what a bank does. When you go and you put money into the bank, you are effectively lending the bank money. They pay you interest for this. They pay you 0.10% interest, way a tenth of 1%. That's what on average they're paying these days in banks. They will then take that money from you at that cost. They also borrow money from larger banks and Federal Reserve Bank and all that kind of stuff. But let's keep it simple. They take money from you. They can then lend that money out to someone else at 8% interest, 10% interest, 20% interest on credit cards. You understand? The bank is collecting money from you, paying you a small amount of interest, lending it back to you and your friends and your family at a much higher interest. So the bank understands that earning interest is senior to paying interest. Earning interest in your money is more important. So here's some examples of some successful people who have mortgages. So Chelsea talked about debt. We're not going to go into a whole the discussion about debt, but I want you to understand concepts and how wealthy people think so that you can start to think and operate with some of the same information. Why does Beyonce and a bunch of other billionaires, why do they have massive mortgages? They can afford to pay cash. Why don't they pay cash? Why don't a lot of wealthy people pay cash for stuff? Why do they still go through the trouble of financing it? Because they understand earning interest on their money, keeping their money working is more important than the interest that they'll pay to have that mortgage. Mark Zuckerberg has a mortgage, right? He refinanced his house to get a 1% mortgage rate. Mark Zuckerberg's a billionaire. His house was $6 million. It took him longer to go through the refinance process.
That's a lot of paperwork.
Yeah, just to refinance his mortgage. Why would a billionaire do that? Because Mark Zuckerberg is going to he wants his money earning more elsewhere than if it's sitting in the house. He wants to keep his money working. Even Warren Buffett. Warren Buffett also got a mortgage. His first house is paid off. That's not the only house he's ever owned. He's had multiple properties. He bought other houses, and then he said, look, I don't want to tie my money up in a house. I want to keep my money working, so I'm going to take a mortgage against it. So Warren Buffett borrowed money to buy a property. He didn't want to pay cash for it. So don't buy the story that wealthy people pay cash. As you can see, most of them do not. Most of them get mortgages. They finance things. A lot of rich people finance things. Even the president of the United States. I'll show you towards the end how we actually use this strategy. So the banker realizes that every purchase costs us interest. That's how he looks at money. He's like, I'm either going to pay interest or I'm going to give up the interest I would be earning. So what if we could use our money without giving up the interest it would earn? How can I keep my money on the wealth curve, keep curving up and growing and not losing value? And how could I then access that money to buy the things I want to buy and do the things I want to do? That's how the banker thinks. So with building your own bank, number one, you would create a pool of money. So as you're working, as you're doing all the stuff you're doing, you have to create a surplus, right, in your money. You have to earn more than you spend so that you can create a pool of money. You put that money to work earning compound interest, which means it keeps building on top of itself and building on top of itself and so on. And then you use that money as collateral when you need cash, meaning you can take a loan against it. You can borrow against it, and your money can keep working for you while you've borrowed against it. So I want you to understand that loans by themselves are not bad. There's good debt and bad debt. Bad debt is, when you go to buy garbage stuff, you borrow money to buy garbage stuff. Good debt is when you borrow money for buying assets, things that are going to appreciate or bring you more cash flow. That would be a good use of that. So one question I want to check in with you guys on this one. If your money is earning 4%, you're earning 4% of your money, will it make sense for you to borrow money at 6%? I want you guys to drop in a comment if you think it will make sense. Just drop yes or no. If your money's earning 4%, would it make sense for you to borrow money at 6%? Would that make sense to do? Just drop in the comments yes or no if you think that'll make sense. Let me know what your thoughts are. I'll give you guys a quick second on here. So Tara says no. Drop in the comments, let me know if your money is earning 4%, would it make sense to borrow money at 6%? So somebody else said no, no, no. I want you to, Tammy says yes. Okay, so you got different answers. Whenever you are faced with like a financial question, it comes down to math. You got to look at, okay, does something make sense or not make sense? And then once you look at the math will help you figure out if a financial decision is correct for you to do or not correct for you to do.
A couple of yeses coming in.
Yes, so people say yes.
No's coming
Justin
in.
says yes. Peter says yes. Okay, so let's look at that. So let's say I go to buy a car. We're going to stick with the theme of a car. If I go to buy a car and I'm going to charge me 6% interest, it's $30,000. and I'm going to pay it off over a 5-year period. All right. That 6% interest at the end of the 5 years, total I would have spent would be $34,799. But let's say I have, some people said no on Instagram. Aaron says no. Jones Red says yes. Okay, so we'll discuss that. So I got $30,000 in savings, and I'm like, man, I want to buy this car. A car costs 30 grand. If I go and finance it, they're going to charge me 6% interest, but my money's earning me 4%. Well, the 6% interest seems more, so I got the money. I should just pay cash. That's how a lot of people may approach this decision. But if you look at the math, and you can run this in a simple calculator, but if you are paying 6% interest rate on a loan, at the end of that 5 years, you would have paid in total $34,799, so almost $35,000, $34,800. However, your money would have grown to $36,630. So in reality, if my money's earning me 4% and I have to pay on a loan 6% on the debt, it would make sense in this case for me to borrow, because dollar-wise, after the 5 years, I would have paid off the car and I would have had more money still left over. See, my money is more than what the cost I would have paid for the car. So a lot of people get caught in just the numbers, but they don't look at the power of something called compounding. Compounding means your interest earns interest on top of itself every year. So in this case, it would have made better sense for the person to borrow money at 6%, even though they were earning 4% on it. How are we on time? What's our time looking like?
12:35.
Okay. So, all right. So number 3, any of your money, market losses. I want to go through this part here really quick. If you had $100,000 and you invest that money, your investment went up by 10% in the first year, and the second year went down by 10%, are you back to where you started? So I'll give you the answer. The answer is no. You earned 10% in the first year. Next year you went down 10%. You're not back where you started. Even though the percentage are the same, whenever you lose money, you have to gain a higher interest rate just to get your money back. So if I had 100,000, I made 10%. Now I got 110,000. If I lose 10% of that, I just lost $11,000. I'm down to 99 grand. I don't even have the 100,000 I started with, even though I went up 10 and I went down 10%. So you got to understand that whenever you lose money, you have to get a much higher return just to get your money back. Aaron says, oops, but that's how we learn, buddy. That's how you learn when you start thinking about these concepts and it starts to make sense. If you lose 20%, you need a 25% gain just to get your money back. So one of the things we do is we focus on using financial vehicles where we don't lose money. And then if we're going to take certain levels of risk, we understand what kind of risks we're taking with it. But when we're building our own bank, we want to use financial vehicles where we don't lose money. It's very important. So to build our own bank, here's the vehicle we use. We use properly designed life insurance policies that build cash. Properly designed life insurance policies that build cash. So I don't mean you're going to go and open your own brick and mortar bank on the street corner and all that. We use life insurance policies for its banking functions. Certain types of life insurance policies allow you to store money inside of a life insurance policy, typically earn a much higher interest rate, vastly higher interest rate than you earn at the bank, and allows you to use it as leverage, which means you can borrow against it while your money is working and compounding. Now, you don't have to borrow against it. You can simply withdraw it. Just like you saw in my previous example, the person with $30,000 withdrew the money. If they withdraw the money and they paid cash for the car, guess what? They would have missed out on the interest they would have earned. So how do I keep my money working and use it to buy other things I want to buy? Well, properly designed life insurance policies allow us to use life insurance for its banking function, and we use it as a tool to build our own family bank. So we store money inside of life insurance policies, and then whenever we want to do this, we borrow against it to buy real estate, to buy other assets, You can use it to buy cryptocurrencies if you want it to. All of these different things. It doesn't matter what you use it for, but you can use it to buy other assets that can exponentially accelerate your wealth. So let's say, I'll get into that in a second. A few features of using permanent life insurance policy in this way. And look, there's different types of life insurance. There's term life insurance, there's permanent life insurance. We own both. One's not better than the other. They just work differently. We use them for different purposes. That's all. With this type of life insurance policy, the reason we can use it for its banking function is, number one, we have no losses. You get guarantees inside of the policy. There's guarantees from losses. Some of them you get guaranteed interest rates, and there's a guaranteed death benefit. So when I die, millions of dollars will get paid to my family as a guaranteed.
Guaranteed winner.
So whether I live, I got access to the money, and I don't, and I die, my family gets the money, and we get to keep any assets that we leverage the policy to buy. I'll talk about that here in a second too as we go through. Protected from creditors. So look, if I'm a business owner and I want to make sure to get a layer of protection, I can put some of my money inside of life insurance policies and shield that from creditors. Liquidity, use, and control. We're actually helping a client right now. He's buying some land, and we're actually setting up a policy that he can then leverage to then go buy the land with it. So the policy is being set up, then he's leveraging to buy the land. So he has liquidity. It's very easy to get access to the money. Use. He can control it. He can choose when he wants to take loans against it, when he wants to keep it building. He can control all of that. While your money is inside of a life insurance policy like this, it's tax deferred, meaning as the money's compounding, there's no taxes on it. Tax free on the distribution. When I want to access my money, I don't have to pay taxes on it. Remember, I said to you, my income went up and my taxes went down. Some of the things we did was reinvested in our business. But if you take access money inside of a life insurance policy, through various means you can access it, there's no taxes on it. It's one of the biggest breaks in the tax code, that you can access all the growth of your life insurance policy. You have access to taking the distributions of it out without paying income taxes on it. All right. You can use it as collateral, which means I can keep it working and use it as collateral for a loan. People will give me a loan against it. My insurance company will give me a loan against it while my money continues to work. Disability benefits. Why, if I'm building my wealth, what if I get disabled? How do I make sure I can my wealth plan, my unbreakable financial house plan can stay on track? I can convert it into income for life. I can use this policy, use it along the way while I'm living, and I can reach a certain age and say, I want you to pay me cash flow for the rest of my life. And it will send me a check every month for the rest of my life. I could live to be 120 years old and I'll still receive a check every month. So that's one of the ways we use it. I can use it to fund my trust, which is one of the things we're doing. Chelsea and I have a family trust. So that's one of the ways the trust is being funded, is through life insurance. So I can fund my family trust. By the way, just as a little aside, we're going to be doing a financial literacy challenge coming up next month, where we're going to go over all those 6 building blocks. And one of them is build legacy. And we talk about all the different types of trusts that you can use and set up, especially if you have minor children, if you have special needs kids, all these different things you can set up, grandkids, all of that. You can establish a trust, and you can fund your trust using life insurance as the funding vehicle. So my permanent life insurance policy can fund my trust. Create generational wealth for my family. We talk about disability benefits. Now, here's the flow of how something like this would work. So first I would fund, this is an example using real estate. So first I would fund a high cash value life insurance policy. I build it up, and while it's earning interest, I just simply take a loan against it. And I go and buy a real estate deal. That real estate deal paid me cash flow. Now I can use that cash flow to reduce the debt on a life insurance policy, or I can use the cash flow for my lifestyle. And I control how I pay the life insurance loans back. I can pay back in a certain schedule. I control that. And if I never pay the loan back and I died, there's a death benefit attached to the policy that will pay off the loan upon my death, and the rest of the money will go to my family. So you see, I have different mechanisms in which I can control this. And let's say I want to flip properties. So I can borrow against the policy, buy a property, and let's say it's taking me longer to fix it and flip it, I'm not in a big rush because I don't have to start paying on a loan back right away. I can control my repayment schedule on a life insurance loan. So that gives me flexibility in terms of my cash flow. So I said I would show you how banks use it. So one of the things is something called bank-owned life insurance. Almost every bank, every major bank in America has billions of dollars in these. There's hundreds of billions of dollars inside that banks store inside of life insurance policies. It's called bank-owned life insurance. So why would a bank that's not a living entity, why would banks put their money in life insurance? Highlighted there, it says, although it may sound strange, bank-owned life insurance is a tax shelter for the bank. It can also offer a tax-free source of funds. Remember, we talk about tax shelter, access to money tax-free. So the banks buy life insurance policies and they store money inside life insurance policies. You can go to FDIC and you can look up Bank of America, Wells Fargo, Chase. All of these banks have billions of dollars inside of life insurance policy. In fact, FDIC considers it a safe place for them to store, for banks to store some of the capital, because they understand making money through these policies. All right. Another person who uses one of these is a guy named Jim Harbaugh. He's a football coach. If you guys follow college football, he coaches at Michigan. This was on ESPN's website that talks about this. So a few years ago, Jim Harbaugh renegotiated his deal with the University of Michigan. And instead of them just giving him a higher salary, he says, for my compensation, I want you to lend me money so I can buy life insurance. Sounds kind of crazy, but why would a person do that? You understand? In America, loans are not taxed. Loans are not taxed when you receive loans in America. When you go buy a car, the car is taxed. The loan you receive to buy the car is not taxed as income to you. So when Michigan loans Jim Harbaugh life insurance money to buy a life insurance policy, that money, millions of dollars, is not taxed to Jim Harbaugh. So it says, in addition to paying a $5 million salary for each of the remaining 6 years on his deal, Michigan will loan Harbaugh $4 million in 2016 is when they did this deal. $4 million in 2016, in addition of $2 million for the following 5 years to pay the premium on a life insurance policy. This was on ESPN's website. So whenever you see these kinds of things happen, you have to ask yourself, why would somebody do that? There has to be a reason why somebody would go to the trouble of doing this. So why would somebody do it? The reason why Jim Harbaugh did this is because that $4 million loan to give him in 2016, zero taxes. The $2 million a year additional to give to him, zero taxes. He just put into a life insurance policy. If he wants it as income, he can simply borrow against the policy. It goes to him as income. And guess what? No taxes on that either.
That's the only time I like the number zero when it comes to my money. Taxes.
So I say that because wealthy people use these strategies to make sure to minimize their taxes. You have to understand, this is the game you're in. You're in a financial game in the United States of America, and there's rules. And the better you understand the rules, the better you can play the game. And so understanding what rich people do allows you to better play the game. And these are some of the strategies that they use. This is in the Washington Post. Current president of the United States, regardless of your politics, since 1983 until the most recent filing in 2015, Biden has borrowed against cash value life insurance policies. The president of the United States owns 6 of these. I want you to understand. So I've shown you how billionaires use it, how wealthy people use it, how banks use it, how a president of the United States. How come he didn't tell you about it? How come he didn't tell you, hey man, I got some life insurance over here, I borrow against it, all that. So he's been using it since the 80s, since 1983. He's had permanent life insurance policies that he has been using, borrowing against it, leveraging it to do other stuff. So now I want to show you, before we wrap up here, I want to show you some quick examples of some of the numbers and different things like that. And I'll show you how you can actually get some of these examples for yourself. We can customize all these for you, all of that, so you can see how it works. So in this example, this person is 35 years old, putting away $1,000 a month. So they're using it as their own bank. They're building this up. If they funded this to age 70, they would have built up 1,339,000, almost 1,340,000 almost. And you also have a $1.6 million death benefit on this policy. So if they died at age 70, 1.6 will pay out tax-free to their family. They're alive at age 70, they got almost over 1.3 million that they can access. They can use it for lifetime income, use it for different purposes, right? Now, how can I use it sooner? How can I use this as my bank a lot sooner to buy assets, buy real estate? If I want to put this towards crypto, if I want to acquire crypto, because I think crypto is going to go to the moon, whatever. Doesn't matter what you use the money for when you take the loan. Life insurance company doesn't ask you what the loan's for. It's a loan against your money in the policy. Remember, you're not a loan from your policy. It's a loan against your policy. It's a big difference. What that means is your money stays in your policy and continues to earn interest. So you stay on the wealth curve. Your money continues to compound always. All you're doing is simply using it as collateral for loans when you want to buy other assets or you want to buy other things. You want to expand your business. You want to put some money towards crypto because you think it's going to go up. You want to buy different things. Here's an example here. This person in a few years been putting $12,000 a year away. Policies accumulate a little over $100,000. They can go take a $100,000 loan against this policy, put that towards. What are you looking for?
Well, I'm wondering if your computer's charged enough that I can unplug it.
Oh, yeah.
Because this one's about to die.
Yeah.
And I will lose the comments.
Yeah, that's fine. So you can use that in earlier years to buy assets, and you can use that to, let's say you and two other people want to put 100 grand each towards buying an apartment building. So now you build up money in your policy. You want to go buy $1 million apartment building. Well, you need probably you need somewhere around 250 to put down towards $1 million apartment building, and you can control that asset, right? So you and two other partners pull your money together. You would take down that apartment deal, and you leverage your life insurance policy to do it. And now, as you did that, your money stays in your policy and continues to compound and earn interest. So you see, that's how something like that works. So
I didn't want to unplug it and have the whole thing shut down.
No, it's not gonna shut down.
All right. Sorry to interrupt.
Yeah. So we've had clients use this to buy real estate. We have clients use this to buy properties in opportunity zones. Opportunity zones are real estate areas and communities that people are looking for more capital. Also, we've had a client use this to buy. He actually leveraged policy to buy Bitcoin when it was at 16,000. So Bitcoin is at over 60,000 today. So I understand when he talked to me about it, he's like, "Hey, do you think I should buy some Bitcoin?" I'm like, "Well, he's a high income earner. That's fine. If Bitcoin went to zero, he would have still been okay financially." But I said, leverage. We can use your policy if you want to take a loan against it, and you want to put that towards the crypto. So that's what he did. So he ended up using that. He got into Bitcoin when it was at 60,000. So it's grown exponentially since then. You pay off the loan on the life insurance policy and use it. So there's many different application ways you can use your own banking through life insurance to do that. Yeah.
That is the key, though, is knowing when you're putting yourself at a stronger financial position or putting yourself at financial risk. So knowing what moves to make at what time. Mm-hmm. And if you guys would like to look into your specific financial house, into how you can become your own bank, you can actually request a strategy call, a financial strategy call. Currently, we are still offering these complimentary, but they won't be free forever. We're not charging yet for them, but we will be very soon. So you definitely want to request your financial strategy call while they are complimentary. And that example that Martin showed you, he can put together a customized plan for your financial goals and your financial house to see what it would look like to become your own bank. So if you would like to request a financial strategy call, you can go to 6buildingblocks.com/strategy. Rain will put that in the comments. 6buildingblocks.com/strategy. There it is. And your free gift that we promised you is we want to give you a free digital copy of our book, Let's Fight About Money. So you can go to letsfightaboutmoney.com/ebook, letsfightaboutmoney.com/ebook. Rain will put that in the comments as well. And you know, the whole reason that we are doing this event, that we're sharing this information, we talk a lot about building an unbreakable financial house. And we mentioned earlier what that means to build an unbreakable financial house, really, so you can handle anything that comes your way financially and create the life that you truly want to live, to reach your potential, to take care of your family, your community, and beyond. You know, however big that you can dream. Like Martin and I, we want to impact the world. We don't want to just have a nice life and pay our bills. Like, we have big goals and dreams. And so that means we have to create a lot of success. And so it's about thinking big. How big do you want your impact to be? And then what's it going to take to be able to do that? And we want to help you do that. We want to help empower you to make the right decisions with the right information and have more control. So,
before you wrap, I want to answer if there's any questions we missed, or any things like that. If you guys have any questions on this, I want to answer your questions before we wrap it all up. So, look, the whole thing here is this very simple concept we're talking about. This is just one strategy. There's lots of things we do for our clients. This is just one strategy of banking through life insurance because it secures your legacy. It allows you to build your capital that you can leverage to buy other assets, which can exponentially grow your wealth. You can leverage it to buy real estate, buy cars, buy all these different things you want to do. We even have these set up for our son, our 16-year-old son. He's got one of these set up for him. And one of the things that I would like to see him do with it, first of all, it's set up that when he's in his 20s, he can leverage it to buy real estate. And one of the things I want to see him do, like when he's 18, is maybe we do, if you guys may be familiar with Turo, Turo. It's like where you can put your car on there for rent. So he can actually purchase a car and he can put it there. He can put it on Turo for rent, and it can actually, every car will bring him passive cash flow each month. And he will be using his life insurance policy to do that with. He doesn't even have a driver's license at 16 yet. I'm showing him how to drive right now. But so I want you to understand that there's different ideas. We've talked about leveraging policies. We're looking at mobile home parks. I like mobile homes. I think it's a great concept. And so that's something that we can use to show how people can build. So if you guys have any questions, feel free to drop it in the comments, and we'll answer it on this subject. We'll answer that for you before we wrap up here. We just got a few more minutes, but thought I'll ask you that. Anything else you want to say?
Yeah, Martin mentioned briefly that we're going to be doing another financial literacy challenge. Some of you may have attended one of our previous challenges. In the beginning of this event, we went over the 6 building blocks that make up your financial house. We're going to be doing a challenge in a couple of weeks where we go over in more detail each one of those building blocks and introduce to you what you need to know about each one, how to identify where you are in each of those building blocks, and what you need to do to get to the next level to strengthen your financial house. So you guys can stay tuned, and we'll let you know the details and how you can register for that financial literacy challenge coming up. And if you guys have any questions, please feel free to reach out. Request your financial strategy call, 6buildingblocks.com/strategy. And we thank you so much for tuning in. We hope you enjoyed the event, and we look forward to helping you strengthen your financial house.
All right, see you guys.